So we'll start with the measuring the divisional performance. So divisional performance can be measured through ROCE or ROI. RI. So ROCE formula works like this. So ROCE equals to capital employed, operating profit divided by capital employed into 100. Okay, so ROCE number will be a percentage number, and operating, how do we find the capital employed and operating profit? So capital employed can be found out through this formula. So take the total assets of the balance sheet and deduct the current liabilities, or if that approach is not working or you couldn't find the data, then use the second formula. Capital employed equals to equity capital preference capital plus long-term debt. So the concept is, however you work it out, you should not include the current liabilities. Okay, so why we don't include current liabilities in capital employed is, current liabilities is a funding we get from the outside third parties. Okay, so it can be from the suppliers, we get payables. Okay, so we don't take into account the current liabilities here. And in terms of operating profit equals to profit after depreciation but before tax. So that is the number that we want here. So depreciation is an operating expense, so you have to consider profit after depreciation but before tax and also interest. Okay, before tax and interest. So that's about operating profit. And the another formula is residual income. So residual income equals to net income minus capital. So this should be in brackets. So into capital into cost of capital percentage. Okay, so usually cost of capital will be in a percentage number, and here it is going to be, the capital is again capital employed. Okay, it's capital employed. So this is the formula which we have to use for both the ROCE or ROI, and the other one is RI. Okay, so both of these have their own advantage and disadvantage, and ROCE or ROI will give you an percentage number, and RI will give you an absolute number. Okay, so or a whole number it will give. So that's about the formulas here. We'll move on to the application of these formulas. So we'll start from this problem. So this problem was asked in June 2011 of ACCA exam, and we'll start from the required. The required is, calculate both the return on investment and residual income of the new investment for each of the two divisions. Comment on these results taking into consideration the manager's view about residual income. Okay, so we have to first calculate it, and then we have to find out whether the manager's view is correct or not. Okay, so it's a 10 marks question. Let's start. Bracco is split into two divisions, A and B, each with their own cost and revenue streams. Each of the divisions is managed by a divisional manager who has the power to make all investment decisions within the division. Okay, so he has the power to make all kinds of investment decisions. Only in an investment decision center, okay, we can employ the RI and ROI formulas. The cost of capital for both the divisions is 12%. Historically, investment decisions have been made by calculating the return on investment ROI of any opportunity, and at present the ROI of investments of each division is 16%. Okay, so the cost of capital is 12% and the current ROI for all the investments have been around 16%. Okay, a new manager who has been recently appointed in division A has argued that using RI to make investments would result in better goal congruence throughout the company. Okay, so he's arguing like that. We just have to give a opinion about that also. And in terms of calculation, so this is the calculation part they have given. Each division is currently considering the following separate investments. So project for division A and the project for division B is there. Two projects are there. Capital required for investment, so that is the capital employed, is given. Sales generated by investment, so that is also given. Net profit margin is given. Okay, so if you see here, if you want to work out ROCE or ROI, okay, so however you want, you can put it, whether it's ROCE or ROI, both are same only. So if you take this sum, see, for division A, they have given only net profit, okay, and that too margin only they have given. They have not given an operating profit. In that case, what we can do? See, in these cases, we have to take an assumption and work the sum. So we can take an assumption. Okay, assumption would be as operating profit is not calculatable from the given data, we are assuming we are using operating net profit as operating profit. So we look at here. So for division A, operating profit, first we'll find it out. Operating profit would be, see, they have given us sales, so that was going to be 44.6 multiplied by the net profit margin, which is 28%. Okay, solve this and you get the answer. So this is 12.48. It's a dollar million. So just mention that. You can also get capital employed. So capital employed is a straightforward number. We can directly get it from there. So it is 82.8. Again, it is dollar million. So to find out ROI, it's going to be 12.488 divided by 82.8 into 100. So let's get the answer. Okay, so the answer is 15.08%. Okay, so that's about the ROI for division A. So let's get the ROI for division B2. So operating profit we find out in the same way. It's going to be 21.8 into 33%. So capital employed is directly given, that is $40.6 million, and ROI will be 7.194 divided by 40.6 into 100. So the answer comes to 17.71. So we got the ROI. So let's get the residual income. So residual income, the formula is this: net income. Okay, the net income can be net profit or operating profit. From there, actually it should not be operating, it should not be net profit, it should be operating profit only. So let's get that number. So operating profit we have already found out for division A. We'll take that and we'll put here. And the capital employed, okay, the capital employed, I think it is already available for A. It is 82.8. So it is 82.8 into the cost of capital, which is 12%. So 12%. So RI would be the minus. Okay, you have to minus from the operating profit the capital employed and cost of capital. If you do, that would be giving you the answer. So this number is also dollar million. Okay, it's a dollar million here. So that's about RI. Let's work out for division B. It's net operating profit. So net operating profit is already calculated, so we can copy it from here. So capital into cost of capital we have to get. So capital employed is going to be 40.6 into the cost of capital, which is 12%. So the answer comes to 2.322 million. Okay, so we'll give our suggestion here. First we'll give our suggestion. So based on our ROI, it is better to invest in which project? Okay, so we have two projects and division B seems to be much better. So it is better to invest in, can we invest in both projects? Because the current ROI is 16, so we can't invest anything below the current ROI. So in that case, we can't invest in A project, so that is like not good. In terms of when you compare with cost of capital, it is 12%. We can invest in both. Okay, so when we compare like with cost of capital, we can invest in both because both are higher than the cost of capital. Okay, to invest in both the projects as project as the project A has 15% ROI and project B has 17% 0.7% ROI, both are higher than the cost of capital. Okay, so that's how we have to consider. We have to consider whether they are higher than the cost of capital or not, and both seems to be good. Okay, but in terms of RI, based on RI, which one should we invest? In terms of RI, if you see, division A project is much better because it gives you 2.522, and actually B is also better because both of them are giving you a higher of it, and the question doesn't say which one to invest. Okay, which one to invest, or they don't have money or anything. So in terms of priority, we can say that they should invest in A, but they can equally invest in B also. Okay, they can equally invest in B also. So we can put like this: based on RI, it is better to invest in both the projects as both have positive RI. Okay, so that's about the concept here. But if you want to say that only one, okay, we'll put like this: in case only one project has to be selected, then ROI indicates to invest in project, which one was the higher? B. And RI indicates to invest in project A. Okay, so that is a conflict here. So each method will tell a different concept of investing. Okay, so that's about this sum. We just have to work out the formula and give a answer. So comment on these results. So that we have made, taking into consideration the manager's view about residual income. So the manager's view was it leads to better goal congruence. Okay, better goal congruence is it is good for both the division as well as the company as a whole. Okay, so it's like whether it's good for both the division and the company. So the manager's view is right. RI leads to better goal congruence between the company and division's goal. Okay, because both of them want to increase the benefit, okay, of the whole amount. So rather than using it as a percentage, it's better to use the whole amount, and RI uses the whole amount. So using a whole amount leads to the betterment of the company. Okay, so we can finish the question like that. So that's about this problem. We'll move on to the next one. So we'll start from this problem. So this problem refers to again RI and ROI. This problem was asked in June 2012 of ACCA exam, and we can read the requirement first. It is a lengthy question, but even though it looks lengthy, it is like quite manageable because it has like all small problems being worked out. See, it's 2 marks, 3 marks, 6 marks, and 5 marks. Okay, so it's not like one big lengthy problem. It is like small parts. So we'll start from required A. Required A is calculate the expected annualized. Okay, so annualized is yearly ROI using the new method as preferred by senior management based on the above budgeted operating statements for each of the division. Okay, so you have to find out annualized ROI and as by preferred by in the method preferred by senior management. What is that method? We don't know. We have to read the question and find out the answer. If you see here, the biscuits division, division B, and the cakes division, division C, are two types of large manufacturing company. While both divisions operate in almost identical markets, each division operates separately as an investment center. Okay, so both are an investment center. As their investment center only, ROI, RI and all can be applied. Okay, each month operating statements must be prepared by each division, and these are used as a basis for performance measurement by the divisions. Okay, so they are creating operating statements to evaluate which division is performing how. Last month, senior management decided to recharge head office costs to the division. Consequently, so that's what I think senior management is doing. Okay, senior management is decided to charge head office cost to the division. So earlier I think they have not done it. Now they are trying to do it. Consequently, each division is now going to be required to deduct a share of the head office cost in its operating statement before arriving at net profit, which is then used to compute ROI. Prior to this, ROI has been calculated using controllable profit only. So controllable profit is similar to operating profit. Okay, control profit is similar to operating profit. So the company's target ROI, however, remains unchanged at 20% per annum. So the target is 20% they have to achieve. For each of the last 3 months, division B and C have maintained ROIs of 22% and 23% respectively. So they have always crossed the target. Okay, resulting in healthy bonuses being awarded to staff. So if they cross 20%, they are being given an award also. The company has a cost of capital of 10%. Okay, so they have given us all the information, and let's see the budgeted operating statement. The statement is, he has given us sales revenue, variable cost contribution less controllable fixed cost, then controllable profit is given, then apportionment of head office cost is given, net profit and divisional net assets are given. Okay, so a list of all the numbers have been given. So we have to just find out the first one is ROI. So he's asking ROI. We'll work out that. So we'll start from here. For both the divisions, we have to work out the answer. Okay, for division B, if you take the operating profit, he says that you have to take into account the net profit. Okay, so number one here it is going to be as per senior management wish, or what we put as per senior management guidance. Okay, use net profit. So that's what he says. So we don't need to use operating profit, we have to use net profit. Okay, in this sum, why we use it? It's because they are saying that use that number. So here it's going to be 311. Okay, 311 is what we are taking here, and for division C it is 292, and capital employed we have to find out the answer. See, they have told us 23.2 is the million, so we have to multiply it by million. Okay, but if you see these numbers are given in thousands, so we have to divide it by thousands. So let's get the answer. Okay, so it seems to be like 23,200, but why are we not getting the answer here? Okay, why we are not getting it? See, we have to find out the annualized ROI. Annualized ROI. So annualized means we can't take 311. Okay, it's for 1 month. Okay, it's for 1 month. See, they have told us for the month of July. For July alone, these numbers are here. Assets usually will be for the entire year only. So this number is for 1 year. So if you put by 12, you will get the answer. So we got the answer. Now we can get the ROI. Okay, ROI would be this number divided by this number into 100. Right? Now, again for division C, it would be 292 into 12. So we got that number. What's assets? Asset we have to again calculate it separately. So assets is 22.6. 22.6. So we got that also. So let's get the percentage. So percentage comes to 15.5. So we got the answer. So A is over. So there are two tricks in this A question. One is the annualized ROI, and the two is the method preferred by the senior management. Okay. So annualized is this net profit is for a single month. So we have to convert it into a year, and the amount here, okay, and the amount which is shown here, 23.2 is a million number. So we have to convert it into thousands. Okay, then only we'll be like getting the answer. So A is over. Let's go for B. If you take B is going to work like this. Okay, we have to read the question first. So division B equals to, the divisional managing directors are unhappy about the results produced by your calculation in A, and have heard that a performance measurement called residual income may provide more information. So calculate the annualized RI for each of the division based on the net profit figures for the month of July. Okay, so for the same net profit number only we are going to use, but we have to find out annualized RI. So again, it works like this. We are going to take only net profit because that is what is given. Okay, so we can put like this. Instructed to take net profit instead of operating profit. We have to do that. So if we take residual income, so net profit is going to be the same number. There's not going to be any change. So we can copy and directly paste it. Okay. So we have this element. So the capital we have to work out. So 23,200 into, what is the cost of capital? The cost of capital is 10%. Okay. Again for B, it's going to be 22,600. Okay, so we'll find out RI. Okay, so our RI comes to 1412 and 1244, right? So they're not asking us to tell which one is better. That and all they are not asking. They just want us to compute the number. That's it. We'll go to the C question. Discuss the expected performance of each of the two divisions using ROI and RI and making any additional calculation deemed necessary. Conclude as to whether, in your opinion, the two divisions have performed well or not. Okay, so we have to use both the methods, and we have to tell which one is like better. Okay, and how both the divisions have performed, we have to comment. So here the question is like little bit telling that you can use any assumption that you want as per your necessity. They are telling like that. So as they are telling like that, we will use whichever is a proper method. Okay, so the proper method are these. To work out this, what we'll do, okay, so to work out, we'll just get the numbers. See, the only number that we are going to change is the operating profit. Okay, rather than having net profit, which is very wrong, we'll take operating profit. Apart from that, everything remains the same. Okay, everything remains same. So operating profit is the controllable profit. So we can put it here. Operating profit or controllable profit is taken as operating profit. Okay, so that's what we are making an assumption. So what is the controllable profit for division B? It is 466 and here it is 472. It is 466 here and here it is 472. Okay, so for division B, it seems to be 466 into 12 gives us 55,592, and our total comes to, our ROI comes to 24.1%, and for division C, it is 472 of operating profit. Okay, here we have controllable into 12, we got the yearly number. Okay, and finally we got a ROI of 25.06. Okay, so it's going to be, it is annualized ROI. Now let's go for RI. So RI calculation is going to be very similar. So we'll just copy the numbers from here so that we can easily finish it off. So again, the only number that is going to change here, okay, we can remove all these numbers. The only number that's going to change here is going to be the operating profit. Rather than taking net income or something like that, we take operating profit. So we can copy this entire thing and just paste it. Okay, so operating profit is 466 into 12 and we got the capital employed, okay, into cost of capital, that also we have put, and finally we got the answer. So that's about our answer. So there seems to be a discussion question also here. Conclude as to whether, in your opinion, the two divisions have performed well. Okay, that's what he simply asks us. So comment Okay, in terms of ROI, let's see how the divisions have performed. So the divisions have performed really well. 24% and 25%, they have worked really well. And when compared to the last 3 months, they have improved itself. Actually, they have moved from 22% to 24% and 23 to 25%. So first we'll put like that. In terms of ROI, both divisions have improved their ROI. Division B has increased from 22% to 24%, and division C has increased from 23% to 25%. Okay, so they have improved. Also, both divisions have ROI higher than cost of capital 10%. Okay, so in terms of ROI, both are doing a better job only. And in terms of RI, okay, in terms of RI, see, they are giving a huge amount of money, so that seems to be really a good thing. Okay, in terms of RI, both divisions are giving positive RI. Okay, so I think that would be like enough. So that's about the commenting part here. So we have finished our C. Okay, we finished C. So we have D and E. So let's still we have a little bit elements here. So division B has now been offered an immediate opportunity to invest in new machinery at a cost of 2.12 million. The machinery is expected to have a useful life of 4 years, after which it could be sold for 2 lakhs, okay, or 200,000. Division B's policy is to depreciate all of its machinery on a straight line basis over the life of the asset. The machinery would be expected to expand production capacity, resulting in an 8.5% increase in contribution per month. Okay, so the concept works like this: the contribution is going to increase, the depreciation is going to occur. Okay, and there's also an investment of 2.1 million. Now the question is whether we can, whether we can invest in it or not. Okay, so okay, sorry, I think it is coming here. We calculate division B's expected annualized ROI and RI based on July's budgeted operating statement. After adjusting for the investment, state whether the managing director will be making a decision that is in the best interest of the company as a whole if ROI is used as the basis for decision. Okay, so we have to recalculate the entire numbers by adding this numbers also. So whether it is useful to buy this machinery or not, you have to tell based upon both methods. Okay, ROI and RI. So both you have to tell. So that's about this sum. So let's start. So before starting, we have a small consideration here. So should the profit, okay, the profit that we are going to work out here, the operating profit, should it be operating profit or net profit? Okay, so because there are two profits which are available and we have worked out an answer for both the profits, we have taken 311 and first we found out an answer, then we found out 466 and we found out an answer. So should we take a control profit or net profit? So that is a first question that we have to answer. So see here, we can use the, as per the normal circumstances, we have to use only operating profit. Okay, but here the question says that we have to judge the business hereafter based on net profit. Okay, if net profit is going to become the criteria, then will this manager invest or not? That is what we have to discuss. So we will put it like this: ROI based on annualized net profit. Okay, so we can, so we'll do work out the sum with that number. So before working out, we have to get the contribution and all. So what is the increased contribution? Increased contribution is going to be 8.5 8.5 of the contribution, which is currently 600. So into 600, and then what would be the depreciation we have to find out. So I think we'll first find out this and we'll put the number. Okay, that's 51. And okay, 51 is for 1 month. So we have to take it for all the months, right? So it should be for all the months. So for all the months, the increased contribution would be 612. So what is the depreciation? So they say that it is 2.1 million. Okay, the cost of the new machinery is 2.1 million. And so first we have to convert 2.1 million, then only we can get the number. So okay, so 2100. Out of this amount, we have to deduct the depreciation. Okay, so 2100 is the machinery worth. So out of that, depreciation is going to be this number. Sorry, scrap is going to be this number, and the machinery would be used for 4 years. So while working out this, we'll get the depreciation part. So it works like this. So the machinery worth is this number. Okay, and depreciation would be 2100, which is expressed in thousands, minus 200 divided by 4. Okay, you will get the answer. So all the numbers we are working out here are in terms of thousands only. Okay, they are in terms of thousands. So let's solve and get the depreciation. So we have to decrease our depreciation, so then only we'll get the profit. Net profit we'll get. So this is annualized profit. So because this is also yearly, this is also yearly. So this is annualized net profit only. So what is the net asset? What is the net assets after investment, or what is the capital employed? We can put okay. What's the capital employed after the investment? So if you see for division B, we have already found out the investment. It was 23,200. So with that, we can add 2,100. Okay, so we got 25,300. So can we divide this number like this? The answer is no. We cannot do that because this is only for the machine. Okay, we have to get what's the existing. Okay, this is additional annualized net profit. Okay, what we have to get is the existing net profit. So existing net profit, we can get it from here. So for division B, this is the existing net profit. So here we can add 137 plus 3732. So we got both the numbers. So this is our numerator and this is our denominator. We got both the numbers. So let's get the answer. A small mistake here. Okay, the machinery worth is not 2.1, it is 2.12. So the number would be this one, 2.120, and our depreciation will change. Okay, so be careful with the small computations. You might like miss it. So this is 132. So it's 3864. Okay, it's 3864. And investment would be 2120. Okay, the asset value that we purchased. So our number would be 25320. Okay, so I think we got the exact answer. So be very careful. Okay, even a small number. So I think rather than taking it as 2.12 million, I took it as 2.1 million. 2.1 million. Okay, so just a small number. Okay, zero point zero 0.02 I have missed, but that 0.02 would totally show a different answer here. So we have recalculated. Okay, we have to recalculate again. Annualized RI we have to do. So that also we'll do. So net income, we have these numbers. You can just copy and paste it. That won't be a problem. And in terms of cost, capital into cost of capital, 5,320 into cost of capital is 10%. So deduct both, you will get RI. So RI is 1332. Okay. So that's about residual income. So we'll just put a comment. State where the managing director will be making a decision that is in the best interest of the company as a whole if ROI is used as the basis of decision. Okay, so he doesn't want us to think about RI, just ROI. So ROI currently is 15.26. Okay, after the investment it's going to fall to 15.26. What is currently it is based on the net profit. So initially we've calculated it is 16. Okay, so why would they invest and get a reduced income? So they will not invest. Okay, they will not invest. So we can put a comment there. Division B manager will not invest in this machine as it reduces the ROI from 16% to 15%. Okay, as simple as that, he will not invest. So that's about the 5 marks we got there. The next one is explain any behavioral problems that will result if the company's senior management insists on using solely ROI based on net profit rather than controllable profit to assess the divisional performance and reward staff. Okay, it's a 4-mark question. We just have to get 4 marks. Okay, 4 points we have to write. So let's see the behavioral problem. Let's see the behavioral problem. So there are 2 sets of numbers which are useful for us. So this number, okay, this I think we'll take the entire set of data. Okay, so look at here. This is based upon the net profit and this is based upon the operating profit. So if you are a manager, what would you consider? See, operating profit gives a better profit percentage, right? So the manager will insist on using the operating profit because he can also influence the number. Net profit he cannot influence because it includes the head of his cost, so it is not, he cannot influence that. So we can take that as one point. Divisional managers will feel that RI and ROI should be based on operating profit as they can control the factors affecting the operating profit. If net profit is used for computing ROI and RI, then they may be demotivated as they cannot control the head office costs. So the second point would be in terms of their averages. Okay, in terms of their averages, they have maintained a 22% and 23%. Okay, and the bonus is also depends upon, okay, their bonus is also depending upon the numbers. Okay, so I think somewhere we read here, see, the company's target ROI is 20%. Okay, so we can put it like this: as the company's ROI target is 20% and the managers are paid a bonus when their ROI exceeds 20%, they will become demotivated if the ROI is calculated on net profit, as this will reduce the ROI below the target ROI, and they could not achieve the bonus. Okay, so that this becomes a problem. Okay, so these two things are becoming the problem here. So one is they if you use net profit, they cannot control the uh, elements in the head office cost. Number two is they are already being paid a bonus and they are exceeding the target of 20%. Okay, so they are well exceeding the targets here. But if you use net profit, the targets would not be achieved at all, because they will only achieve only 16% and 15%, so they won't get the bonus. So I think these 2 points like nicely summarizes both the all the elements here. Okay, so we could stop the problem till here. Okay, so hope you guys can work out this problem. It is a little bit lengthier problem. Okay, in terms of complications, I don't think it is like quite tough. Okay, it's not quite tough, but it is a little bit lengthy. So that's about this problem. We'll move on to the next one.